Hello YouTube. Today we are visiting the old video that was posted on the 16th of November 2025. I basically gave you a bias on this particular day on the 16th, and I wanted us to visit that particular video. There are some things that you guys might have missed out that I need to point out to you. So here it is, right? Let's go through the video and I'll talk about some things that you missed. If you notice, the very first thing about this particular video is that I'm talking about this daily wick. We are using it as a resistance, particularly the 50% of that particular wick. Now, if you notice, this candlestick on the 16th of November is still trading. I am giving you guys a bias while I don't have the full confirmation. This is showing you experience. I've seen this happen a lot of times. Typically, in a trending market, you can clearly see that we're making lower lows. So of course, I would expect that these key PD arrays on the daily time frame to be used as a resistance. Now, I did not have the full confirmation as price action was still trading. I know a lot of guys look at old lows broken through and they want to treat them as resistance. Well, that's a big problem because price action does not work that way. I've tried support and resistance. Trust me, I've tried. These lows, if they get broken below in a bearish market and we want to treat them as a resistance, kind of like a break and retest type of setup, well, 80% of the time it does not work. If it did work, I would have been long time ago profitable. I would be living in the Maldives, somewhere out there. See, it does not work. Price action comes back into daily wick consequent enrichment. Price was still trading. If you look at this video, it's still trading. I did not have full confirmation. I had it when this candlestick closed, but I did not need for it to close. There was no need for it to close for me to have a bearish bias because this particular fair value gap has already tipped its hand to me. Well, step index on a daily time frame. See how price action has respected that particular daily wick consequent enrichment. On this particular day, on the 16th of November, I know it says down here that it is the 15th, but it's really the 16th. Okay, let me change my time zone to my local time. This was the day, the 16th of November. It was on a Sunday. Price opened up, traded higher into the daily wick consequent enrichment. If you've been following along with this market commentary and you noticed that price action is respecting this particular wick consequent enrichment, what did you think was happening here? Even though price is consolidating, banging around the daily consequent enrichment, isn't that showing you that it does not want to close above the consequent enrichment? And what does that mean? In a bearish market, price respecting consequent enrichment of a particular wick, notice that we have all of these lows up here. That was a support broken down. Why wasn't it used as a resistance? Well, that's because we had this daily wick consequent enrichment. That was the resistance. I spoke about it in that particular video. I told you my bias before I had this candlestick closure. I spoke about it. I gave you a bias even though I had no confirmation. I just trusted that this particular daily wick consequent enrichment is going to be used as a resistance. There's no need for price action to go all the way up here for it to resist. There's no need. This daily wick consequent enroachment, it shows you that price action is weak. It has already told you on the 14th of November. I produced a particular video as well on the 14th of November showing you that we have a bearish bias because of this inefficiency. It's large, and what is price action coming back up here to do? It's coming up there to resist on this daily consequent enroachment. What is that? Order flow. It's tipping its hand. It's telling you, my guy, that man, I don't have the energy to go up there. It leaves a wick. I spoke about this. When price action visits inefficiencies, but the daily candlesticks are doing what? They are closing outside of the inefficiencies themselves. That is a strong market tone that is bearish, extremely bearish. Now, I want to show you something about this daily candlestick that happened on a Friday, the 21st of November. If we zoom in a little bit, this particular day, the 22nd, which is today, a Saturday, price action opened, traded up. It had no interest in the 50%. These are the ideas that I would use for the lower time frames. Okay, I would frame my particular setups based on what is happening on the daily time frame. This is how I have a high winning strike rate. I use strictly daily key levels. Okay, so these daily key levels, I look at them and say, okay, I have the 50% and I have a bearish bias. Should price trade above this particular wick, then my bearish bias, I'm going to throw it out of the window. See what this particular day is doing? It's trading up, but has no interest in going into the 50%. What is that telling you? Order flow is bearish, extremely bearish. We open for a new trading day. We have no interest in visiting the 50%. If I see that particular signature relating to order flow, this is order flow, good people. If I see that on the daily time frame and price action has been bearish, for November I have been bearish, good people. If I see that particular signature, PD arrays on the daily time frame are not being traded back to, that indicates bearishness, market that is weak. I quickly go back to the previous price action. What do I find here? This low on the 20th of November, it is nested with the 15th of November. What do I teach about the 20th? It tends to be a contrarian trade model. But what are we seeing with this particular 20th of November? We are seeing price action print relative equal lows. Price action here is tipping its hand, saying, I don't want to go above the 50%. This is where the relative equal lows are going to be attacked. So I hop over to the lower time frames. Step index on a 1 minute time frame. I just want to scroll up to show you that these are the quadrant levels of the daily time frame now transposed to the lower time frames. If we scroll back, I just want to show you guys what happened with the 50%. We opened up here. This is the delineation for a new trading day. So we opened up, we had no interest in the 50%. We don't want to visit this particular level. That is order flow tipping its hand to you, saying, I don't have interest in going up. All right. If we zoom in a little bit, okay, we zoom in a little bit, you will notice that price action it left these inefficiencies open. What are these inefficiencies? They are breakaway gaps. What are they breaking away from? The 25%. Do we want to visit the 25%? No. We'd rather be bearish. We'd rather leave these inefficiencies open. Okay? So for the rest of the day, we are bearish, good people. We are bearish. So here comes the opening range for London session. I've switched my time zone to New York, right there. The London session begins at 1 o'clock, but the opening range is from 1:30 to 2 o'clock. You're looking for an inefficiency that is so obvious to the eye. Okay? Is this the inefficiency? No. Is this the one? No. This right here, it is a bearish inefficiency. It is large than all of these inefficiencies here. So the largest inefficiency is going to be the one that you are looking for inside of your opening ranges. The very same inefficiency has been used as a resistance multiple times throughout the day. Why does that happen? Why do we use these inefficiencies multiple times throughout the day? It depends on the market condition that you are experiencing. If we are having a consolidation market like we did on the 22nd, then just know that that particular consolidation, it negates that inefficiency. A timed-based inefficiency is going to be retraded back to multiple times throughout the day. Okay, I hope that makes sense because that's very important. If you're experiencing a market consolidation, that timed-based inefficiency is going to be a magnet. It's going to draw price back to it multiple times throughout the day. It's going to offer you a setup multiple times throughout the day. Okay, so here is the first setup. We use this inefficiency as a resistance multiple times. Price has already taken out the buy side liquidity pool here. It breaks down, it gives you a fair value gap. You sell short inside of the fair value gap, you target these relative equal lows. Clean setup. It's a clean setup. So the market starts to consolidate. All right, so it leaves these inefficiencies and it goes up. Look at how it breaks above the very same inefficiency and quickly turns that key level into a support. But notice that it does not want to go into the daily wick. That is order flow. Okay, it's telling you that, hey man, even though I'm supporting on this inefficiency, the London opening range fair value gap, even though I support there, I have no interest in going up. Okay, it leaves these relative equal highs here, trades lower, comes back up, uses the very same opening range as a resistance. This is the resistance and support ideas, good people. Trust me, you apply these inefficiencies at a time of the day. Okay, here is the London lunch. It has supported on the bullish order blocks down here. Since it is a consolidation market, the PDRAs that you're going to use are order blocks in a consolidation market. I'm referencing this inefficiency here, right? So we trade there inside of the London lunch. It's an hour from 5 o'clock to 6 o'clock New York local time. It's an hour long. What is price doing here? It's going up to attack the initial highs of the day. After we took out the initial highs of the day, it trades lower. Where is it going? the London opening range. What do we do with the London opening range? Well, when the London lunch ends, what begins? The New York session begins trading. So here is the New York. From 6 o'clock it begins. It trades lower. What does it create here? A market structure shift. If we had inefficiencies up there, would you expect price action to go all the way up into those inefficiencies to offer you a selling scenario? No. Why? Time. The London opening range. New York session. That's your setup. We don't expect price action to go up to give us a setup while we have the London opening range. I am teaching you guys how to scalp in this market condition, utilizing the London opening range fair value gap. Somebody in my comment section asked me how to do a small scale scalping type of setups in step index. This is the way, good people. We do it with time. So here is the New York opening session at 6 o'clock. We trade lower, we create a market structure shift, we go up, hitting the London opening range, fair value gap, consequent enroachment. What is price candlesticks doing here? They are closing below the consequent enroachment. Where is the relative equal lows, my guy? Here is the London lunch, and here is the London low. Relative equal lows. That's your target. But price action goes a little bit deeper. It goes a little bit deeper because it has a strong pull to the downside. It is weak. It is bearish. This is how I used to trade step index. And I am teaching you for free. So I hope you found some insight in this video. I'll see you guys on the next video.